So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be going through mostly FX pairs today. However, if we have time, we could have a glimpse also at gold, WTI, maybe even US stock markets. Making a start with Euro USD. And it's clear that the downward trajectory of the pair is ongoing. So practically we see how the pair dropped, breaking the 1.0825 support line and is currently aiming for the 1.0775. Mind you, this is the daily chart. Definitely we have to switch this into a resistance line, given that the price action has moved below it. Lock it in. Let's also correct the labels. Sorry. Starting with the R3, which is now being placed at the 1.0950. The R2 at 1.0885. The R1 at 1.0825. The S1, and this is a key level, we'll explain later on why, at the 1.0775. The S2 at 1.0725. And the S3 at 1.0665. Now, on the one hand, we highlight that the outlook remains bearish, and that tends to be very clear given the downward motion of the pair over the past weeks. My opinion, maybe this downward trend line could be unified in the following sense. Yeah. There are 1, 2, 3, 4 elements which play a role here. The first is definitely the downward motion, which is guided by the downward trend line initiated since the, let's have a look up here, the 30th of September. As long as the downward trend line remains intact, we maintain our bearish outlook. Furthermore, we also note that the RSI indicator has remained near the reading, actually at the reading of 30, also suggesting or highlighting, if you prefer, a strong bearish sentiment on behalf of the market for the pair. One small word of warning here. The fact that the RSI indicator is at the reading of 30 may also be implying that the pair is at oversold levels, so it could be ripe for a correction higher. Yet, I would be noting that the price action still has some distance between itself and the low Bollinger Band, implying that there is still some room for the bears to play around and push the pair lower. I would be highlighting another element, and that's the M formation. We have drawn 1, correction, neckline, 2, and now we're reaching where the M formation has started. It's a very clear formation, and it's nearing its end, leaving practically the question mark about the future direction of the pair. Should the bears maintain control over Euro USD, I would expect it to drop below the S1 1.0775 clearly, and start aiming, if not testing, the 1.0725, while even lower, I note the 1.0665 support base. Especially the last support line has a very clear level which provided support a number of times. That was in June. On a fundamental level, I'm quite worried about the euro, in the sense that there is some wide uncertainty about the direction of the eurozone, both on an economic level and on a political level as well. The economic part, or if you prefer the macroeconomic part, as ECB President Christine Lagarde eloquently put it, there seems to be little prospect for growth in the economy of the eurozone. And in my opinion, exactly this lack of prospect tends to weigh on the euro sign. Economic activity is a key factor to that issue. We're getting, if I'm correct, Eurozone's GDP rate, Germany's GDP rate next week. And may I remind you guys that in the last quarter it was confirmed that the GDP of Germany was at the technical negative at minus 0.1% quote unquote. Now, should we see that also quarter 3 GDP rate is in the negatives, that would be putting practically Germany's economy in a technical recession. Not of the brightest moments for the German economy. On a monetary policy level, ECB's dovish intentions are more than clear. It's characteristic that media are highlighting the possibility that ECB policymakers are debating right now whether the bank should practically escape, or if you prefer, the monetary policy should escape the neutral level and enter a more supportive role for Eurozone's economy, implying of the monetary policy, i.e. more rate cuts to come. Also note that the market prices in that ECB will be cutting rates up until the end of the year to the rate of 2%, which is substantial. And we're talking about, if I'm correct, the deposit rate here. For the remote scenario that the bulls take over, I'm highlighting this as a very remote scenario. However, there is a possibility. I would require for a bullish outlook practically the pair to reverse direction, breach initially the mentioned downward trend line in a signal that the downward motion has been interrupted. I would also require it though to breach above the 1.0825 and reach, if not breach, the R2 1.0885. Okay, let's have a look at USD/JPY. USD/JPY continued to rise in a further indication of USD strengthening and at the same time JPY weakening. It's characteristic the movement which occurred for the pair during today's Asian session and early European session, where practically the pair broke the 152 resistance line. Now we have to turn this into a support line. Sorry. Let's reposition the labels. Setting the R3 162. The R2 158.35. The R1 at 154.80. The first support line at 152. It used to be a resistance line, we just turned its role around as the price action moved above it. The S2 at 149.10. And the S3 at 146.45. Locking everything in. We maintain our bullish outlook. I think that's clear given the upward motion of the pair, especially for the past 2 days and during today's Asian early European session. The RSI indicator has even breached above the reading, slightly above the reading of 70, which tends to highlight the strong bullish sentiment of the market for the pair. And at the same time, maybe also flashing warning signs about a possible overbought level of the pair, which may force it to correct a bit lower. Yet at the same time, I would be noting that the price action has not even reached the upper Bollinger Band, so there is still some room for the bulls to advance higher. Should the bulls maintain control, I wouldn't be surprised to see the pair, breaching the 154.80 resistance line and starting to aim for the 158.35. However, that would definitely, we're talking about an outlook for a week or so. Remember, this is the daily chart. On the flip side, should the bears take over? For bearish outlook, it seems to be very remote right now. For bearish outlook, we would require the pair to correct lower, breach the S152 support line, breach the pre-mentioned upward trend line, and also breach clearly the S249.10. We are talking about 400 pips of movement lower. I know that it seems not only far-fetched, and I concur with that opinion, it is far-fetched, but for a bearish outlook, I'm going to be quite conservative and require more. Let's have a look at GBP USD. Okay, we are repositioning the labels a bit. So the bearish outlook seems to remain, albeit not with the same intensity as with Euro USD. It's still present, and it seems to be leading the pair towards the S1 1.2890. We're talking about cable always. The RSI indicator remains between the readings of 50 and 30, actually really closer to the reading of 30, implying that the bears have it, maybe not as intense as before. Should the bulls take over, we may see the pair reversing course, rising, breaching the pre-mentioned downward trend line, breaching the 1.3030 resistance line, and start aiming for the 1.3260 resistance level. I have one small word of caution here, and to demonstrate it, allow me to drill into the 1 hour chart. And I'm going to be widening it. Note how in the past 24 hours, the pair has started to have higher truths and higher peaks. This is the 1 hour chart. I know this is not practically implying any bullish outlook, but definitely it tends to imply a slight stabilization. And that's a bit worrying because there is a bearish sentiment, yet it's still weaker than what Euro USD has. So we may see some stabilization efforts emerging. On the other hand, note how we have one peak, lower peak, lower peak, lower peak, and once again a worse. You have one trough, lower trough, lower trough, even lower trough, but the next one is higher. So bearish outlook still present. However, the possibility of a stabilization of the pair is also present. Keep that in mind. Moving now to USD CAD, which is the main pair of the day. Now, let's first of all reposition the labels and set everything on right, so we get a clearer picture of the pair's movement. Now, on a fundamental level, I'm highlighting USD CAD as the main pair of the day because we have BOC's interest rate decision today. The bank is widely expected by the market to deliver a 50 basis points rate cut. That means practically lowering interest rates from 4.25% to 3 and 3.75%. CAD OIS imply probability of around 92% for such a scenario to materialize, and that's currently. I would be also noting another element which CAD OIS also implies is that the market prices in more or less that the bank will proceed with another consecutive 3 single rate cuts in its next meetings. And that's an issue because it's not only the rate cut as such which matters, but also the bank's intentions and how it will communicate those intentions to the market. So we are seeing practically 3 scenarios playing out, which could have different effects market-wise on the Canadian dollar, on the loonie. The first scenario is the more obvious one. It's that the bank delivers a 50 basis points rate cut as the market expects, and at the same time signals that it's ready to cut more. And that signal could be conveyed practically either through the accompanying statement or by BOC Governor McClellan's press conference, which is about 45 minutes after the release of the interest rate decision. So expect some volatility for CAD pairs at the time of the release as such, and at BOC Governor McClellan's press conference. It's not a once-off element, there is continuance. The second scenario which could play out would be that the bank delivers a 50 basis points rate cut, but fails to signal the readiness or its readiness to cut rates further, or maybe even signaling that it's prepared to maintain a more moderate rate cutting path. Maybe not 3 consecutive rate cuts in the following 3 meetings, but one at a time, and we see for the next one. Now, the third scenario, which could take the markets by surprise, and that would be, in my opinion, a rocket booster for the Canadian dollar, would be what would happen if the bank fails to deliver a 50 basis points rate cut and actually cuts rates by only 25 basis points. So the market may be expecting a 50 basis points rate cut, but the bank delivers a 25 basis points rate cut. Such a scenario would take literally the markets by surprise, provide asymmetric support for the Canadian dollar, and in that case the market would have to reposition itself, which would be implying that it could have a negative effect on USD CAD as a pair. It could drag USD CAD far lower, and it would be keeping practically the CAD supported on a monetary policy level. My expectation would be that the bank cuts by 50 basis points and may provide in its forward guidance or McClellan's press conference some signals that it's ready to cut more. However, I wouldn't be surprised to see the bank preferring to keep its options open and not locking into any specific mode. There will be a message conveyed about a willingness to cut more, but at the same time, I wouldn't be surprised to see the bank highlighting that it will continue on a case-by-case basis and remain data dependent. Now, the first element could provide bearish tendencies or some slight bearish tendencies for the Canadian dollar. The second element could contradict them and practically provide some bullish tendencies. It's a very interesting aspect on what the message will be and how the bank will phrase it and how BOC Governor McClellan will be defending whatever the bank's decision will be. Okay. On a technical level, the bullish outlook is in a make or break position right now, given that the pair corrected lower yesterday, yet seems to have renewed its bullish tendencies today. Should the bulls maintain control, I would expect the price action to rise, breach the R1 1.3845 resistance line, and aim, if not to reach the R2 1.3945. That would be proving practically that the upward trend line remains valid. It may be shifted a little bit to the right, yet it would continue to be valid and continue to push the pair higher. I would have to note here also that the RSI indicator is at the reading of 70, which highlights the strong bullish sentiment of the market for the pair. At the same time, maybe also implying that the pair is at overbought levels and is ripe for another correction lower. But note how the price action has some distance to reach before reaching actually the upper Bollinger Band. That implies us that the bulls have a free card should they wish to push the pair even higher. There is room for the bulls to advance even higher. On the other hand, should the upward trend line be clearly broken, which by the way is being put to the test right now, and the pair clearly breaks it, possibly even breaching the S1 1.3720, that would be signaling a bearish outlook or the beginnings of a bearish outlook for the pair. Okay, let's have a look at the Aussie. There you go. So we have AUD USD in the limbo. It's a big question mark, and whether the pair is heading towards south or not remains stable. There are a number of elements which could be commented upon. The first would be the breaking of the downward trend line, and whether that's a clear break or whether that's a shift of the downward trend line to the right. In my opinion, it's the second. And the fact I'm highlighting for the bearish outlook to continue is that practically the pair in its correction higher failed to clearly break the R1 0.6705. At this point, I would also like to note that the RSI indicator remains between the readings of 50 and 30, which highlights a bearish predisposition on behalf of the market, and also see how the price action has some distance to cover until the lower Bollinger Band, implying that there is still some room to play for the bears here. So practically I'm going to redraw the downward trend line. And I'm highlighting this like here. Should the bears maintain control and actually today's selling interest be extended, we may see the pair aiming of not reaching the S1 0.6570. However, that may be a matter of 2 or 3 days. And always under the assumption that the bears maintain control. Should, on the flip side, the bears give up and the bulls take over, for a bullish outlook, I would require the pair to rise, breach the mentioned downward trend line clearly this time, breach also the R1 0.6705 resistance line, and start actively aiming for the 0.6820. Nothing less. Okay, let's have here Hamza, which is asking to have a look at gold. Definitely we'll have a look at gold right now. It's a beautiful chart, and it's a very interesting chart in the following sense, that gold's price, or let me rephrase it, gold bulls seem to have no limit. The upward trend line guiding the the precious metal for the past 1.5 weeks is more than evident, but in my opinion, the upward movement was initiated far earlier. Let me clear the chart a bit. And to tell you the truth, gold is rising against all odds. And I'm highlighting here all odds on a technical and fundamental level. Because you have the USD rising, which normally should weigh on gold's price, it doesn't. You have US yields rising, which should also present a more lucrative alternative to gold as a buying instrument. It doesn't. So what's left is practically that the prospect, or if you prefer, the risk, which is inherent in the US but also on a global level, tends to provide safe haven inflows for gold's price. Practically, I see the case for gold's price to continue to be on the upside, and allow me to delete this one as well. On a fundamental level, we're living trading wise in very, I wouldn't say difficult, but challenging times. We have on a fundamental level, especially for gold, lots of fundamental issues at once. It's characteristic that in the past, any of these issues, and let me explain them, could rock gold price. And what we're seeing today is that we have a blend of fundamental issues which are occurring at the same time. It's as if we have the perfect storm. And let me name a few. Definitely, we have the US elections, which is critical to the outlook on the economy of the US, but also on a global level. It's a big issue. Uncertainty is high. The stakes are high. So it's understandable that investors may take a refuge to gold's price. One. Second, we have two issues which are coming out of China. The first issue is definitely the trade wars between the West and China. And may I add here that China's macroeconomic outlook, it's not as good as to reassure traders about the global economic outlook. It's characteristic that the Chinese government and the PBOC are issuing constantly stimuluses for the economy. We have also an issue which concerns the relationships of China with Taiwan and the rest of the world, and also tends to tantalize gold traders. I would be also highlighting the situation in the Middle East, where it may be contained right now, yet the possibility of the situation in the Middle East actually expanding and evolving practically in a regional blown out war is always present. The war in Ukraine is another big issue, and it's questionable whether the Russians will be winning or the Ukrainians will be winning. That's not what I'm talking about. What I'm talking about is that Ukraine practically destabilizes the whole southern eastern flank of Europe, and the outcome is unclear. And all of that combined, it's understandable that it's going to continue to lead gold prices high. I think the big picture becomes even more evident if we drill into the weekly chart. I don't need to tell you where gold's price is heading to. The price action shows it. And if we take, say for example, one upward trend line, second upward trend line, and now we have the third one. I think it's more than obvious. So technically, on the long-term perspective, the upward motion or the bullish outlook is being maintained. One small word of caution here, or if you prefer two. A, the RSI indicator, which has surpassed the reading of 70 and tends to strongly imply that the precious metal is at overbought levels and ripe for correction lower. The second is the fact that the price action is flirting, has surpassed yesterday the upper Bollinger Band, also suggesting that the bulls should slow down somewhat and the precious metals price to correct a bit lower. But the bullish outlook for the time being is more than clear. Let's not forget that the precious metal is at record high levels. The big question is where it's heading to. Once again, I'm very conservative. I have to state that in advance to you guys. And it's characteristic that we are talking and setting limits of resistance support lines at intervals of around $50. It's characteristic that the price action has breached the R1 2730, and that has to be placed practically as a support line now. So the next possible target for gold bulls would be the R2 2780, even higher than that. It should be broken within the next 2 days or 3 if gold prices do not correct lower. The next possible target for the bulls would be at the 2830. Once again, we are basing this on the width of the movement over the past 1.5 weeks on average. Okay, let's have a look at WTI. WTI's price action is in a sideways motion, and despite the rise of practically Monday and Tuesday, it has hit a ceiling at the 71.40 resistance line. In my opinion, it's understandable why oil traders are puzzled, and for a bullish outlook for WTI's price to emerge, I'm keeping a very high bar. I would require the pair to rise, breach the 71.40 resistance line clearly, but I would also require it to have a higher peak than this one. So the price action has to breach also the R277.85, and once that's broken, then I'm talking about a clear upward movement. For the time being, I'm highlighting I do not see an upward trend line, given that you may have higher truths, but you're lacking higher peaks, because after this one, the next one was lower. So I expect the sideways motion to continue. It's characteristic also that the RSI indicator is running along the reading of 50, implying a rather indecisive market. More or less, for a bearish outlook, I would require the WTI's price to drop, and not only drop, but to break the 64.60. I would require a lower trend than this one. So the WTI's price has to drop, break the S1, opening the way for the 57.15. By the way, at this point, let me drill to the weekly chart and note that should the pair drop below the S1, which is the 64.60, then we're talking about levels not seen practically since November 21. And even at that moment, the price was at rather low levels. It continued higher. Technically speaking, there may be some difficulty for the price to drop lower. Back to the daily chart. Let's have a look at US stock markets. And let's have a look at McDonald's. This is an interesting trade. This is the daily chart of McDonald's. I would like to note here that we had some interesting news about McDonald's, and they were concerned about a possible lawsuit about McDonald's, against McDonald's. And if that's the case, that could be an issue on a fundamental level. On a technical level, the upward trend line continues to support McDonald's, which tends to highlight the possibility of further advances. Allow me to have a small technical analysis here. Setting the first resistance line up here, and okay, weekly. We're nearing record high levels here. Yep. Support line being set one here. Second support line here. And the third support line here. Could go lower, possibly yes. Here. See this show here? It was tested once, twice, 3, 4, fourth break. That seems to be valid. And we can set the second support line here. The first support line a bit lower for some fine tuning. And the resistance line here. It's a very, very interesting chart. Setting the R1 at 317.35. The S1 at 259.55. The S2 at 281.75. And the S3 at 265.25. Next resistance line should be set at 330. Could go 335. And the one even that higher at 370. Too high, 60. Let's readjust also the labels. Once again, the bullish outlook seems to remain, albeit one small word of caution for McDonald's is that it may be overbought and ripe for correction lower. But as long as the upward trend line remains intact, we tend to maintain our bullish outlook. And always one idea would be, a good idea would be to follow the trend. If you are contrarian, you can always risk it, but it's quite doubtful whether you can beat the market on this one. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's Okay, let's go ahead and get started. So, for those of you guys who've just joined, today we are talking about the advanced harmonic strategy. As per usual, before we get started, a disclaimer and risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. Disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to do a brief recap on Fibonacci in case any of you guys weren't around for those webinars. And then we'll look at market structure, followed by an intro to harmonics, and then we'll look at the different types of patterns. So feel free to let me know in the chat if you guys have any questions throughout the webinar. And yeah, let's go ahead and get started. So firstly, let's start off with the different Fibonacci retracement levels. So these are the Fib numbers that we normally use. So you can take a screenshot here if you want. But now that we know how to draw the Fibonacci retracement trend line, which you can see in the GIF here, basically drawing from the top to the bottom, ensuring that you follow the shape of the market structure pretty closely. Okay, so then we can look at the different types of levels. So we have the levels that are ranging from minus 61, all the way to more than 100%. Why do I feel like my video is kind of lagging? Okay. Yeah. Where was I? Yes, so these are the different levels that we use, and they each have a different technique for the range. So for the negative levels, so minus 61.8 as well as the minus 27.2, we look at using Fibonacci expansions. So an expansion, I'll show you guys how we can use it in a bit. Next, we have the mid-range Fibonacci retracement levels, and those are from the 23.6 to 78.6. And then lastly, we have the levels that are greater than 100%, which would be our extension levels, and those are the 127 and the 161.8. Okay, so you can see the main three levels that I talked about in our previous slide are the retracements, expansions, and extensions. And you can see exactly how they are used in our GIFs here. Don't worry too much about this projections GIF, because we're not going to be focusing on that for now. So for retracements, it's exactly the same. You're just following from the top to the bottom. For expansions, which are the levels that are less than 100%, less than 0%, so the negative levels, you're mainly looking at finding this lightning bolt kind of shape or like a flash symbol. And then you're taking the starting point and ending point, and you are kind of projecting where prices are headed towards once price has fully surpassed that level here. Okay, so it has to surpass or retrace at least 50% of your initial trend line before you can use this expansions technique. Okay, and then we're projecting where prices will head towards the minus 27 or the minus 61. Okay. As for extensions, we are looking for reactions off of the levels that are greater than 100%, so 127 and 161. And for extensions, we are looking for this Nike tick kind of shape. So you can see our starting point, ending point here for our trend line. Once price has fully surpassed that 100% starting point, then you can go in and use this technique. Okay, so we're basically watching for reactions off of the 127 and 161 for this technique here. Why do I feel like my video is frozen again? Can you guys hear me? Okay, I think the audio is fine. It's just the video. Um, so I'll just switch the video off for now. Oh, is the video okay as well? Okay, now it's okay. Okay, let's just move on. So if it freezes again, I'll just switch the camera off. Okay, video is stopping. Yeah, I'll just switch it off then. The next time that it freezes. So anyway, these are the different Fibonacci retracement levels if we're looking at it all at one glance. So you have the positive Fibonacci retracement levels that are greater than 100%. Over here, those are your extensions. Your mid-range would be between the 0 and 100, and your negative Fibonacci retracements, which are also your expansions, those would just be the minus 27.2 and minus 61.8. So the reason why we are going through Fibonacci first is because harmonics plays a lot into the theory um, behind Fibonacci levels. Okay, so we'll just do a brief recap on it in case there are some of you guys who haven't been with us for that long. We do have a 4-part series on Fibonacci if you guys were interested on that. Yeah, so we go through in depth in each webinar the different types of Fibonacci's. But for this webinar, I'll just do a really quick run through of each of the techniques. Okay, so let's move on. We're now going to look at a couple of examples. So here you can see I've drawn a retracement level from this 0 to 100. My prices have rebounded off the 61.8 level. Here you can see prices are rebounding off this overlap level. So what an overlap level is basically when there are swing highs and swing lows that respect that area. We call it an overlap because the bulls and bears of your price are respecting that area. Okay, so here we can see our 38.2 prices reacting off of it. And that's also in line with that overlap level. So when you combine your horizontal levels, like your pullback, your overlap levels, with your Fibonacci levels, then it really strengthens your analysis and the chances that prices are going to rebound off those levels. Okay, so for harmonics, normally it plays off of the 61.8, which is also called your golden ratio for harmonics strategies. So the main levels that harmonics uses are the 61, 78, and also the 127 and 161.8 that we went through earlier. So the 38, okay, just give me a second. Okay, sorry about that. Um, yeah, so if you're just using Fibonacci without the harmonics, we look at all of the levels. But I just wanted to highlight, since we are talking about harmonics, 61, 78, and the levels that are greater than 100, which we'll touch on in a couple of slides. So in this slide, we are focusing on the 61.8 level. First retracement we have is this bigger one here. And you can see the 61.8 lining up with the swing high here. The second Fibonacci retracement we have is from this swing low to the swing high. Prices bouncing off of this swing low support level are also in line with a 61.8 retracement. Okay, so this shows you 61 is a pretty common level that's used to determine potential reversal points within harmonic patterns. Okay, here we are briefly touching on Fibonacci expansions. So for expansions, I talked about the flash kind of shape or like a lightning bolt symbol. So you can see the yellow arrows kind of form that shape. So your expansion level basically traces out the start or the head of your shape. Okay, so this works especially well because you have the mid-range Fibonacci levels. Here you can see a 61.8. And you're also using the negative level, so the minus 27.2 is where we are projecting price to come down and bounce off of. So your 61.8 is your typical retracement level that we've seen in the previous examples. And your minus 27.2 is basically where we are expecting prices to reverse off of. So you can see that's exactly what happened here. Price bounces off really nicely from the minus 27.2 expansion level. Okay, a pro tip is that price usually comes back to the ending point. Ending point is basically the first swing low of your shape. Okay. Okay, so now let's look at extension levels, which are your Nike tick levels. The yellow arrows draw really nicely the shape. You're basically taking the head of your tick and projecting prices where prices will reverse off of. So this Fibonacci extension is also commonly used in harmonics as well. So namely the 127 and the 161.8, like we see here, prices are reversing off of it. And yeah, so you see that huge reversal off of this level here. Okay. Okay, so here's a GIF that shows you how to identify the shape and also how to draw your trend line and what you can expect to see from this 127 and 161 levels. Okay, so for Fibonacci projection, I'm not going to dwell too much on this. I'm just going to briefly mention it a bit. But basically for your Fibonacci projection, we are using that same flash shape that we saw for your expansion levels, so the levels that are less than 100%. For extensions, projections, we are using the Fibonacci extension tool. So it's a bit confusing, but it's a completely different tool compared to the tool that we've been talking about for the past 3 strategies. So for this method, we're using the Fibonacci extension tool on TradingView, and that basically uses 3 points. Okay, so you can see in the GIF, we have a starting point, middle point, and ending point. And the levels that we're looking at are 61, 78, and 100. 161 if you're looking at using an Elliott wave. So ultimately, unlike the other 3 methods that we went through, this uses 3 points. So 1, 2, and 3, and you are following exactly that lightning bolt kind of shape and projecting where prices are going to reverse off of. Okay, if we look at another example of this, you can see really clearly the starting, middle, and ending points follow the swing highs and lows of price. And price has bounced off of that 100% very nicely over here. So here's an example with a very obvious zigzag or lightning bolt shape. Here you want to take note of the Fibonacci trend line that follows the market structure really closely to project the price to reach your 78.6% Fibonacci projection level. Okay, so let's see how this plays out. So you can see price has reversed off the 78.6% Fibonacci projection according to our previous analysis. Last example, take note of that zigzag shape again, or flash shape. This time it's kind of inverted, so instead of being upright like this, it's upside down. Notice that there is a very clear movement in price structure, which our Fibonacci projection trend line follows. The starting, middle, and ending. And then your last part, or the tail end of your lightning bolt shape, follows your projection. So you're projecting where prices will bounce off of. So here you can see we're projecting prices to bounce off the 100%, and that's exactly what happened here. Okay, so for invalid Fibonacci retracements, one of the most common scenarios of this is when price makes a lower low. So that's assuming if you are drawing a Fibonacci retracement from the top to the bottom. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are in negative that we saw earlier, but basically they go beyond your endpoint and they are still valid. So for example, here we have prices breaking below your ending point. So this then becomes an invalid retracement. So you always want to remember to pick the lowest point with nothing on the right of that ending point. Okay, now let's talk about market structure. So this is pretty important regardless of whatever strategy you are using, but particularly for harmonics because you're basically using price action. So these swing highs and lows are too insignificant, so they're bad points to use for your Fibonacci points, but they're also bad points to use for your support and resistance levels as well. Okay, so when you're choosing a chart, you can flip between the different time frames to choose a chart that gives you a really clear market structure with significant swing highs and swing lows. So you can see that the Fibonacci trend line cuts through the price structure. So this is something you want to avoid, especially when you are drawing your harmonics shapes. You want to make sure you follow price structure very closely. Okay, we saw this earlier. Okay, so let's get into our brief intro to harmonics. So harmonic patterns are pretty popular trading strategy since it involves technical analysis and it identifies potential price reversal points in financial markets. So these patterns are based on Fibonacci retracement and extension levels, which is why we went through them before going through some of these patterns. And these are basically mathematical ratios that traders believe are significant in determining potential support and resistance levels. So harmonic patterns foundation was laid by H.M. Gartley in 1932 and later developed further by many authors like Scott Carney in his book of harmonic trading. So harmonic patterns basically reflect geometric price structures. So for example, retracements, projections, and swings. These adhere to Fibonacci ratio relationships. In other words, retracement, the projection price swings that form these patterns and are interlinked together based on specified Fibonacci ratios. So the ratios that we normally use for harmonic patterns are those I mentioned earlier, 61, 78, and the levels that are more than 100, so 127 and 161. So these harmonic structures exhibit unique price structures or movements and key turning or trend reversal points. This factor is very helpful in trading as it provides highly trustful price entries and key levels for targets or stops. Unlike other trading methods, harmonic trading attempts to predict future movements, and this is what differentiates it from other indicators or oscillators, which tend to be lagging, and in terms of how they work as well. Okay, let's briefly talk about some basic pattern identification. So some of these patterns can be quite complex and a bit technical to understand, but once you understand the pattern structure, they can be spotted quite easily. So these patterns are either forming or completed M or W shapes. Or they could be combinations of M or W as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D, and price swings between these points are interrelated and have harmonic ratios based on Fibonacci. Okay, so Fibonacci ratios are really helpful in trying to understand and defining precise turning points in these patterns. Okay, so starting off with the W bottom, you can see where exactly we're expecting price to break out of, where you should place your targets. For an M as well, it's just the opposite. So there are many variations of the W or the M patterns. And yeah, this is what we're talking about, the A, B, C, D, E shapes. Or it could be labeled as X, A, B, C, D as well. The main thing is that there are 5 points that are labeled on your patterns. Okay, so here's a 5-point pattern example. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate the keynotes X, A, B, C, and D. So 5-point harmonic patterns have a critical origin X followed by an impulse wave XA. That's followed by a corrective wave to form the eye of the pattern at B, completing the AB leg. So basically this purple level there. And then it's followed by a trend wave, BC, and finally completed by a corrective leg, CD, that ends around the potential reversal zone. So if you look at this diagram, the levels, these like 0.38 to 0.618, these are your Fibonacci levels that we're using. So if I were to place a Fibonacci trend line here, one here and the ending point here, you can see that price has retraced 61.8% of your original line. So that's basically just what the levels mean. Okay. So here you can see projection at 161.8, retracement at 88.6, projection 261.8. So a possible pattern formation is identified after the first three legs, XA, AB, and BC are completed. So you're projecting your reversal to happen from somewhere here. Okay, so your entry level should start about past this area here. So potential trade setup is recognized as the last leg CD starts to develop. Fibonacci ratio extensions, retracements, and projections are then used to determine your potential reversal zone or your PRZ, which you can see here. This is basically your if you've been with us, the Fibonacci confluence area, this could be one of your area as well. Because you're basically projecting prices to reverse off of that area. So hit down, be attracted to the area, and then bounce off. So it's kind of that same concept. So all harmonic patterns have a clearly predefined PRZ. The initiation of new trades should take place in this zone and only after price reversal pattern action. Okay, so let's start with the first pattern, which is the Gartley pattern. So it was first outlined by H.M. Gartley, and the Gartley pattern is probably the best known harmonic pattern. Structure and appearance wise, the Gartley pattern typically forms in a trending market, and it has an M shape in a downtrend or a W shape in an uptrend. Okay, so remember, because these are kind of reversal patterns. So that's why we're calling this a bullish Gartley, because it should be in a downtrend, and then we're looking for a reversal into an uptrend. Bearish because it's an uptrend, and we're looking at a reversal into a downtrend. So how it works, or the rules for a harmonic pattern, the AB leg should retrace about 61.8% of leg XA. BC should retrace 38.2% to 88.6% of XA, and CD is at least a 78.6% retracement of leg XA. Okay, so long positions should be considered after a clear bullish reversal with a stop loss that's placed below here. So you can see the PRZ happens around point D. So we're going in for a buy here, and you place your stop loss below your buy level. So target 1 for this pattern is at your 38.2% retracement of your AD. So if you draw a Fibonacci retracement here, as long as it's 38.2% above 38.2, you can place your target profit there. While target 2 extends towards the 61.8% of AD. So if price breaks out of that 30.2% retracement, then you can go in continuously for a buy towards your 61.8. So the bearish Gartley, of course, is just the opposite of that. If you're using a bearish Gartley, your short positions should be considered after that clear bearish reversal. So off of this D, with a stop loss placed above the D level. Okay, again, target for this pattern is 38.2% retracement AD, while target 2, 61.8% retracement of AD as well. Okay, so the concept behind Gartley pattern is based on the idea that after a significant price move, so this huge shoot upwards, the market will retrace AB followed by another move in the original direction before completing the pattern with a final leg, which is your CD. And this ends at a Fibonacci retracement of your initial A move. Okay, so once you understand it, it's pretty straightforward. Okay, now let's look at the next pattern, which is your bat pattern. So the bat pattern is typically considered to be the most accurate pattern. In terms of structure and appearance, it's pretty similar to your Gartley, but has a different Fibonacci ratio. Also has an M shape in a downtrend or a W shape in an uptrend. Okay, so the main rules of the bet are AB can retrace between 38.2 to 50% of XA. BC can retrace between 38.2 to 88.6 of AB. And CD can retrace up to 88.6% of XA. CD leg can also be an extension of between 161.8 to 261.8 of AB leg. Okay, so your completion D typically will lie about 88.6% retracement of your XA leg, like we see here. Okay, so for long positions, you can consider them if we're looking at bullish bet, long positions would be after that D level. So you place your stop loss here. Your potential reversal zone will be this purple highlighted point, and prices are headed upwards, so you can place your take profit. Again, 38.2 retracement of this level, AD, or 61.8 as well. Stop loss will just be placed below here. Similarly for bearish bet, prices heading downwards, your stop loss will be up here, somewhere here, and you're heading towards 38.2 or 61.8 retracement of your initial leg, which is your XA. Okay, so the difference between bet pattern and Gartley is that the bet pattern emphasizes a deeper retracement in this AB and also a shorter extension in the CD leg compared to Gartley. So it's also considered to be more reliable than Gartley due to this deeper B retracement, which also allows for better risk to reward ratio. Okay, any questions so far? Okay, if not, let's move on to the next pattern, which is the cipher pattern. So for cipher, again, it's formed by 4 price swings that's labeled as X, A, B, C, and D. This is more complex compared to the other harmonic patterns. And yeah, it also uses different Fibonacci ratios. So the Fibonacci relationship here, XA leg, which is the initial price movement, can be either direction. So here it's up, bearish would be downwards. So your AB leg after that should be between 38.2 to 61.8 of the original XA. Your BC leg is a sharp extension of AB, typically extending to 127.2 or 141.4 of the AB leg. So here you can see we are employing that Fibonacci extension technique that we used earlier. BC leg is, we talked about that already. Your CD leg retraces from your BC leg, ending at a level between 78.6 and 100 of your XC leg. So for this level, you would connect your X to your C level in order to determine whether your D is part of the cipher pattern. Okay, so this is pretty distinctive from the final leg of other harmonic patterns, such as your butterfly or your Gartley. Yes, an entry is after the pattern. Endpoints of the legs are wicks or body of candles. We normally will include the wicks as well because we are using Fibonacci levels. Yeah, so even if we're not looking at harmonics, just Fibonacci, we take into account the wick as well. But yes, entry is after the pattern. So once this pattern is completed and we start to see that reversal, then we will go in for the buy. For bullish, for bearish, here you can see, that's why we call it bearish, because once price is moved up, once it reverses, we're going for a sell here. Okay, so the concept behind this pattern is based on the idea that after a specific series of price movements, and you can see it's very specific in terms of the retracement levels, um, the market is likely to reverse direction. So it differs from other harmonic patterns in that the BC leg, so this one here, extends beyond the starting point of your XA leg. So it creates a deep retracement for your CD. Okay, so again, this pattern is considered one of the most accurate harmonic patterns with a high probability of predicting your reversals. Okay, so again, target levels you can stick to typically 38.2 to 61.8 of your CD leg here. So you place your target somewhere 61 or 38. Stop loss will be placed slightly beyond this X to protect against a false breakout. Okay, any questions? Okay, here's an example of your cipher pattern on an actual chart. So you can see, yeah. So I think if you look at it at one glance, you can't really see what's going on. So you do have to go in and use your Fibonacci retracement tool to label all of the levels, the 78.1 that we mentioned, the 127, yeah. But yes, so you can see once price reverses off of that D level, then we'll go in for a buy. These patterns can work on any chart. You can see in this example, we're looking at Euro Yen on the 1 day time frame. So I'm sure you could find it on gold as well. Although now on gold, prices are kind of moving in an uptrend, whereas these harmonic patterns tend to work better in trending markets. So, but still you might be able to find it on gold as well. So yeah, it works on any kind of chart. Okay, let's move on. So next, we're going to look at the butterfly pattern. So butterfly pattern also uses the M or W shape, but it's different from Gartley and Bed in that it extends beyond the starting point of your pattern, which is your point X. So the Fibonacci relationship, again, we're looking at AB retracing 78.6% of your initial price movement, so XA. And then for your, I talked about AB, yep. So next is BC, and you will be looking at a 78.6% retracement, 30.2 to 88.6 retracement on your XA. and your CD would just be a 1.61. Actually, these are levels greater than 100. So it'd be 161.8 to your 261.8 level. So again, here you are seeing that same Fibonacci extension level. Okay, so yeah, that's why we went through your Nike tick shape, because you can see very clearly how it would work on some patterns as well. Okay, and lastly, of course, your CD is a 127 to 161.8 retracement of your XA. Okay, so concept behind this is that it basically indicates a potential market reversal beyond this starting point. So that's the difference between godly and bad. It's also a more aggressive pattern, so it predicts a stronger reversal. So it's based on the idea that the market often will overextend beyond the initial impulse move, which is your XA, before it starts to reverse. Okay, we have a question. Are the patterns best seen on daily charts? It kind of depends on your trading style. Um, we normally will use this on either daily or for 1 hour or 4 hour time frames. So we normally won't go anything below 15 minute. I think 30-minute works as well. But anything below 15 minute tends to get a little bit harder to analyze because charts are noisier. Yeah. So normally 30-minute, 1 hour, 4 hours, or daily works as well. Okay, but generally your harmonic patterns increase in reliability with higher time frames because they are less influenced by, your short-term fluctuations and market noise. So that's why we normally use 4 hours or daily. Okay. Lastly, or not lastly, but we are going to look at the crab pattern. So crab pattern was actually released in 2001, and this is a pretty extreme pattern as well because the corrective wave, your AB, should end between 38.2 and 61.8. Okay, so for the Fibonacci levels, you're basically looking at XA as the initial price movement again. AB is the retracement of 38.2, 61.8, as I mentioned. BC is 38.2 to 88.6 of your AB. CD is just the defining feature of your crab pattern, which is an extreme extension of the XA leg. You can see it's 161.8. It can actually go even higher. So if you look at your BC extension, here if you're using the Nike tick method that we used earlier, you'll be looking at somewhere between 224 to 361. So this is the defining feature of your crab pattern. Okay, so this pattern was discovered by Scott Carney, and it's considered one of the most accurate harmonic patterns as well, simply because of this deep extension of the final leg. Okay, so yeah, this is I think it's the largest extension, especially for the last leg here. Okay, Next, let's look at the shark pattern. So this pattern is relatively new, also introduced by Scott Carney. This pattern is unique because it doesn't follow that traditional XAB CD structure that we've seen in the other harmonic patterns. Instead, it uses a 5-point structure that's labeled OXABC. So it's known for its sharp price patterns or price movements and the ability to identify potential reversal zones before the final point of traditional patterns. So structure and appearance-wise, it's characterized by this steep OX initial move, followed by a sharp retracement of your XA, deep extension, again your AB, and another retracement BC, which is considered a continuation or a reversal pattern depending on where it forms in the trend. So in this example, we are using it as a reversal. That's why you can see price after the completion of the shape. We are projecting it to reverse. But if you found it somewhere between the BC line, of course, you'd be expecting a continuation. Okay, so the strength of shark pattern is that it is able to identify potential reversals earlier than the other patterns, such as your crab and your bat, because you're looking at this price pattern before its completion. So you don't have to wait for your C level to form before going in for your trade. Reason being, your BC level is so long, so if it doesn't fall within this 113, you can just assume that prices are going to continue. Once it hits or it falls anywhere between 113 and 161.8, projection of your AB, then you can go in for a buy or sell if you're looking at the bearish shark pattern. Okay, so the target profits, where you should place your target profit and stop loss, for all of these patterns lies about 38.2 to your 61.8 retracement of your this final line here. And then your stop loss would just be outside of that initial line. Okay, now let's look at the advantages and disadvantages of harmonic patterns. So harmonic patterns provide future price projections and stop levels in advance and are considered leading indicators. They're frequent, repeatable, reliable, and produce high probable setups. And the trading rules are relatively standard since they're using Fibonacci ratios. And they work on all time frames and on all market instruments. Other momentum indicators like your CCI, RSI, MACD, DMARC, and so on can be used along with them as well. Some disadvantages: harmonic patterns are complex and highly technical to understand. Correct identification and automation or coding of harmonic patterns is difficult. Conflicting Fibonacci retracement and or projections make it difficult to identify the reversal or projection zones, and complexity arises when we get opposing patterns from different time frames. So the risk reward factors from some of the patterns are also pretty low. And yeah, that's all I have for you guys for today. Let me know if you guys have any other questions. But if not, thank you guys so much for joining me. I hope you guys found this session helpful and have a great rest of your week. And if you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.